Let's go. Is it a shortened holiday week? Are you getting ready for the parade and Santa Claus and football on Thursday? That means it's Thanksgiving week, and that means it's Monday of a shortened holiday week here on the floor of the NYSE. Welcome to the show. This is the market open from the street here at Post 35 of the New York Stock Exchange. Today is Monday, November 21st. Is it the 21st? I think it is the 21st. Yes, it is. Welcome to the show. Opening bell rung here on the floor just moments ago by S&P in celebration of that company's 50th anniversary. As we speak, the major market index is in a little bit of mixed territory. The Dow is certainly being helped by Disney. That is going to be one of, if not the top story that we talk about here in just a moment. To that point about what is on the show this morning with Martin and myself, let's take a quick look at what is on tap for this morning's show. We'll be breaking down the biggest factors that are driving the market on what is, again, a bit of a shortened week. If I'm not mistaken, we got a normal session Monday, Tuesday, Thursday, off Thursday, half a day Friday. Monday, Tuesday, Wednesday, we have a session. Off Thursday, half a day Friday. There we go. Plus, we'll talk Disney as former CEO Bob Iger takes back the helm amid uncertain times. Remember, once upon a time, he said, I'm not really interested in being CEO again. And then, oops, here he is. Later on, we'll also talk crypto as that market continues its rapid collapse. For more on those stories and so much more, we bring in Mr. Martin Baccardax. He's our senior editor. He is our chief markets correspondent. He is the man in the know on all of these things and so much more. Martin, I assume you want to start with Disney. This actually broke pretty late last night. I was up pretty late, and I was preparing for this morning's show. And right when I thought I had a very firm, solid grasp on everything possible that you and I could potentially talk about today, in comes the breaking news. Let's pull up the line here. This is from Susan Arnold. She leads the Disney board. If we could pull up the quote. She says, we thank Bob Chapek for his service to Disney over his long career, including navigating the company through the unprecedented challenges of the COVID pandemic. The board has concluded that as Disney embarks on an increasingly complex period of industry transformation, Bob Iger is uniquely situated to lead the company through this pivotal period. Martin, what was your reaction to this as this broke late last night, and what's been the reaction for investors so far on this Monday morning?
Well, there were a lot of market murmurs, JD, it has to be said, after Disney's fourth quarter earnings earlier this month. The conference call wasn't particularly satisfactory. Of course, they missed on the top and bottom line, and they posted a $1.5 billion loss in the direct consumer business, which is where Disney Plus and the streaming operations are housed. So there was absolute disquiet. Obviously, the stock is under the throes of one of its worst declines in about 4 decades so far this year. It has just massively underperformed the Dow and virtually all of its competitors. So something had to be done. But I was surprised to see the level in which all of this escalated to on Sunday evening. Reports say that Bob Iger was only approached by the board on Friday evening with respect to sounding out his temperature for taking on the CEO role and indeed coming back after his retirement. So this moved very, very quickly in a shocking manner. I think Chapek, to some degree, hadn't really insinuated himself within the board in terms of finding their confidence. And ultimately, the fourth quarter miss and the rather flat discussion that followed in the conference call was probably the straw that broke the proverbial back.
What was it about Mr. Iger you think that has, obviously endeared himself either to fans of the brand or people on the board that makes him the suitable candidate to come back into the fold during such a difficult time?
I think they just need a steady hand at the tiller, really, JD. Ultimately, the parks division is doing well. It's ramping up visitors as a result of the drop in COVID restrictions, China, of course, aside. So really what Disney appears to need is somebody who can come in and manage the media assets in a significant and indeed efficient manner. And that was absolutely not Mr. Chapek's skill set. He was more of a theme park person, and that's where his expertise lied. Whereas Iger is a dyed-in-the-wool Hollywood executive who understands exactly what's happening both on the content and the distribution side. So having him in for this 2-year period is really important for Disney. And it also probably alludes, at least in my estimation, JD, to some activist shareholder pressures that have sort of bubbled up over the last 3 or 4 months. And maybe the board saw Iger as a better representative for Disney's interests than Mr. Chapek.
Yeah, I wish we had the sound. I know we don't, but it was really only, I think, the end of last year, earlier this year, he sat down with Kara Swisher, and Kara Swisher directly asked, so, there's been all these rumors, Bob, of you coming back to Disney. He's like, what? Who, me? I would never. That's not even remotely on my radar. But of course, we always know there are a little bit of a difference of conversations behind the scenes versus then what the reality reflects. The stock is currently up about 8%. As a story like this develops, Martin, from your years of expertise, what is something you will be looking for in the days ahead? Obviously, keeping in mind it's coming in at the beginning of a shortened holiday week. Maybe some people would say it's strange timing. Maybe some people would say it's perfect timing for this. But is this the bulk of the announcement, or are there more details you expect about Iger's return that you think will be really important in the story for people to follow?
Yeah, I'd be terribly surprised if this were the end of the discussion, JD, for sure. Whether or not we will find out precisely what the reasons were for the board's decision to terminate Mr. Chapek remains to be seen. But I think now my suspicion is that some of these activist concerns, which had raised their head in early September, actually probably going back to August, are going to sort of resurface as part of the central discussion to Disney's strategy going forward. There's a hedge fund out there named Third Point, which is run by a billionaire investor named Dan Loeb. He has a position, I think it's worth about $1 billion in Disney as last checked. And he, over the summertime, had put forth a letter to the board saying, listen, there's all sorts of things that need to be changed, including the fact that you guys should look at the spinoff of ESPN as a way to have it as a standalone entity, to reduce group debt, and to allow the company to focus more on cost cutting and driving the Disney Plus growth story as a result. Now, he backed away from that shortly after, following some conversations with Mr. Chapek himself, who called ESPN central to the Disney growth story. I do wonder if that's going to remain central now under the leadership of Bob Iger. I don't know for sure, and I haven't read anything yet that would suggest that ESPN is back on the table, but I cannot imagine that that conversation isn't going to resurface, and that is going to raise all sorts of questions about exactly how Disney wants to navigate this three-pillar empire. It has, of course, the theme parks division, which is doing well, linear broadcasting, where ESPN sits, and direct-to-consumer. Now, linear broadcasting, of course, is suffering from the cord cutting that we have seen over a number of years. Direct-to-consumer is suffering as a result of it being just increasingly more expensive to get new subscribers in, given the content costs that require to harness them, and of course the intense competition from Netflix and others that are out there. And of course, theme parks is running along nicely, but for the most part, its growth drivers are completely separate to those of linear and direct-to-consumer. So you have disparate business divisions that are all functioning under different business cycles that Mr. Iger is going to have to manage, whilst at the same time dissuading activists from getting too impatient about the fact that the stock, again, is in the throes of its most significant year-to-date decline since the early 1970s.
Before we move on here to anything in the macro environment specifically, anything else here on the Disney point that you would want to stress as we do continue to see how the stock is performing after this pretty shocking announcement on Sunday night?
Yeah, I mean, ultimately, I think the near-term headwinds for Disney are just as significant as they were prior to this decision, JD. I mean, obviously, we have COVID acceleration in China, which is going to implicate Disney Shanghai and maybe possibly even spill through into the European tourist season, which is coming into the springtime. And of course, there is no solution just yet to the rising costs that are hurting profits at the direct-to-consumer business, and Disney Plus essentially isn't going to turn a profit until early in the next fiscal year, which is the fall of 2023 at the earliest. So I can't imagine that those drivers are going to change anytime soon. So Disney will, as a result, probably have to accelerate any significant changes that it would like to bring forward in order to make sure that the momentum in the stock today carries through into the end of the year.
Take a step back now and talk more broadly here as we do kick off what is, again, a bit of a shortened trading week. What's top of mind for you, and something you think that investors might want to very closely pay attention to outside of course, the pretty big announcement from Disney that we already just covered?
Yeah, I'd say the Fed minutes on Wednesday, JD, are probably what the market is looking to, as well as what the pace of shopping is for Black Friday and beyond. But the Fed minutes for the November meeting will, of course, give us clues as to the conversations that were taking place amongst the Open Markets Committee when they unveiled their fourth consecutive 75 basis point rate hike. Now, of course, the Fed has started to tweak its message just a little bit over the past weeks. And actually, over the weekend, we had what seems to me one of the most significant divergences in opinion, where Susan Collins of the Boston Fed said that 75 basis points is still on the table for December, whereas Raphael Bostic of the Atlanta Fed said he would prefer to move away from those jumbo rate hikes. So there seems to be some split thoughts as to where we are going to be in December. But for the most part, everybody is on the same hymn sheet as to where we will get in terms of a terminal Fed funds rate, i.e. the highest point at which the Fed will hike and then hold for a long period of time. That seems to be around the 5 to 5.25% rate, and it will probably arrive there in the early spring. So whatever comes out of the Fed minutes, I think, will be probably of paramount importance for the markets, as well, again, what information we get out of Black Friday shopping, or indeed Thursday, early door crasher sales on Thursday, Black Friday on Friday, and then rolling into Cyber Monday at the end of the weekend.
You know, it's been interesting because I feel like even the rules of the Black Friday shopping game have changed, large in part because of the Amazons, because of the big box retailers, because of this effort to say, oh, let's go line up on Thanksgiving night at 5 o'clock. And then I feel like there, over time, became a lot of public pushback to doing that. And then you kind of, it goes hand in hand with this other cross current of the growth of e-commerce. What do you follow in terms of that Black Friday data? And I feel like, and usually we actually get it pretty quickly, right? We usually don't have to wait like many days after Black Friday. I feel as if we get some sense pretty early on, and it's going to be pretty important for people to pay attention to, especially given the goals of the Fed to essentially limit the spending power of the American consumer. But Martin, it doesn't really seem as if the American consumer, at least so far, has necessarily gotten that memo.
No, the last man standing, it seems, doesn't it, is the American consumer. And they'll probably have a really, a reasonably robust shopping weekend, I think, from all accounts that I've been reading, from Deloitte to MasterCard to virtually everyone else. The MasterCard numbers are interesting to me, JD, because they look at the differentiation between online and physical store spending. And actually, they're more bullish on physical store spending this year than they are on online. And I think that's sort of rolling into a few of the topics that you and I have discussed over the past weeks. One of the trends that we have seen in retail, particularly with clothiers, is the fact that people are buying apparel in order to sort of spend more time outdoors, to go to more events, and to sort of just throw off, if you will, the shackles of the pandemic restrictions. Now, of course, we're a long way from the pandemic, but nonetheless, those trends continue to accelerate into the second half of the year. So that tells me that people might have more of an appetite to get to those gate crashing events and to get to stores, particularly department stores, than they have been in the past. And MasterCard actually thinks that department store sales are going to drive an enormous percentage of the growth for Black Friday sales this year. And I think that's a really interesting dynamic. Now, whether or not we'll see a corresponding decline in online remains to be seen, because at this time, a lot of the retailers, of course, have hybrid offerings where they have, purchase online, pick up at the curb, and that sort of thing. So separating those will be more difficult. But I do believe that we are going to see more physical and feet on the ground shopping, both at box retailers and indeed at department stores, than we have probably since 2018.
So do we want more spending or do we not want more spending? And I guess it depends on who we is, right? Because I guess if you're the retailers, you're on the one side of the coin. And I guess if you're the Fed, you're on the other side of the coin. Perhaps my view of it is far too simplistic, but I have to imagine something has to give here with regards to the strength of consumer spending. What am I missing from this equation?
No, I think it's an accurate sort of assessment, JD, because I think ultimately what the Fed would like to see is something somewhere in the middle, where you have reasonably solid consumer spending, and obviously, as a result, services sector consumption, which is a big driver of U.S. growth, but not to the point where it's going to get embedded into the economy and elicit further price pressures into the new year. Now, the best thing about Black Friday and holiday spending writ large is that it doesn't tend to carry over into 2023. This is a spending dynamic that is generally constricted to the period in which the spending takes place, i.e., once the sales are done at the end of December, there really isn't a carry through into next year. So I don't anticipate that even if we have a better than expected season it's going to factor too deeply into the Fed's thinking because it simply isn't the sort of thing that builds momentum going forward. So they can still be reasonably confident that they are on top of the inflation game as a result of what they're doing. They'll be far more focused, JD, on what happens in the employment market than they will with respect to shopping receipts from Black Friday and into the end of the year.
I do want to ask you about seasonality. Of course, we do have the Macy's Thanksgiving Day Parade on Thursday. Santa Claus comes out at the end of it, and that means we are, whether we want to or not, already essentially in the heart of the holiday shopping season. Through the lens of seasonality, are there names, are there sectors, are there industries that you, as a journalist, Martin, will cover or look at the data for far more closely, given the unique maybe opportunities or unique threats that this holiday shopping season poses? What will you be following that you think might be important for someone watching this broadcast to say, oh, I didn't think about that. Maybe I want to also track how that company or how that industry does over the next few weeks?
For me, JD, I have always tried to look at three aspects to the consumer economy, particularly around the holiday season. One is travel, one is restaurants, and one is food shopping. So essentially, food shopping is the one that I think is the most important. When you have an economy that's downtrending and when you have a consumer that is looking to pull back on their consumption as a result of the disquiet that they're reading or the concern that they have for their own employment future, they tend to spend more on food than they do on gifts. It tends to be that sort of celebratory thing that people see as a bit more austere, and as a result, they're more comfortable spending money that way. If we see food sales escalating or outpacing that of consumer goods, that would be a concern for me in terms of what consumers think about the economy going forward. Travel, I think, is another important one and is expected to be extraordinarily robust into this holiday season and beyond as people sort of like really exercise their demand for pent-up voyages and experiences that were heretofore unavailable to them during the worst of the pandemic. And then restaurants. I think from all the way back in my very early days in the financial markets, it was embedded into my thinking that the restaurant industry is an excellent precursor of consumer confidence, and people will dine out and spend more money eating in restaurants if they are feeling more confident, and they will pull back on that spending if they are not. So to some degree, that goes hand in hand with what I was saying about food and grocery sales. But for the most part, that they do sort of exist in separate silos. But those are the three things, JD, that I will be looking at when I'm sort of trying to understand what it is that we're seeing from those nominal figures that we'll get for Black Friday and holiday shopping.
Yeah, before I move on, I was curious, was there anything specifically more on the travel front that you think is going to be interesting? What have the trends showed us with regards to a bit of a bounce back? You know, we frequently talk about revenge travel post-COVID, and I did that, right? You're stuck at home for so long, you're like, for the love of God, just get me on an airplane. Just send me anywhere. I need to see the world. I've been stuck at home for far too long. And I wonder to what degree that has continued, or, you know, have you read about potential concerns with regards to travel if there is a pretty significant pullback? We do have a bit of a tick up in unemployment in 2023. Is travel one of those things most likely to be impacted if and when people do finally start to say, oh, I better watch where my dollars go?
There's no sign of it yet. The airlines are really confident about what they expect for demand going into the end of the year and indeed beyond. But what they aren't doing, JD, is increasing capacity to meet that demand. So the one dynamic I would say that will be consistent to the travel industry going forward is that if you are someone who's getting ready to board a plane this week or indeed into the end of the year, be patient, bring a pillow and something to read, because they are going to be crowded flights, they're going to be crowded airports, and everybody is going to be on edge as a result. I think it does speak to some degree to some, I wouldn't say irresponsibility, but to some slow-footedness from the top-level executives at many of the biggest carriers, although in their defense, they've had a very difficult time bringing on cabin staff and indeed pilots as a result of the tightness that we're seeing in the labor market. But the fact that capacity hasn't increased while demand continues to accelerate is certainly something that's going to weigh on the travel experience, but probably not on profitability for the major carriers.
Yeah, of course, because remember, we had all these scores of essentially forced layoffs or early retirements during COVID when those major airlines were facing all that squeeze. By the way, a personal question here, Martin. When you fly, when you travel, are you a neck pillow guy? Do you always have a book? Do you go for the crosswords? Also, is there a go-to snack for your air travel. Any of those questions you're comfortable addressing? It's very important questions.
These are all great questions, JD. Go-to snack is gluten-free pretzels, which makes me sound a little bit millennial, but nonetheless, that is what I enjoy the most. I will download films onto my tablet to make sure that I'm not a slave to what is being offered in the entertainment systems from the airplanes themselves. And no, I am not a neck pillow person. I have dignity, particularly when facing the public, and as such, I behave so. You will never
like
see
that.
me with a neck pillow.
I do like that. I never thought to tie the dignity part. I'm not either. I've never used one, never had one for an airplane. Those are very good responses. And I got to say, Martin, for all the expected answers on where I saw that question going, gluten-free pretzels was not on my list. So color me very surprised for that. So I do appreciate that. Very good. Okay, I do want to talk to you about. Yeah, no, I a point very well taken. Thank you for letting me ask we asked the hard-hitting questions here on the show. So speaking of questions, though, I do want to get your perspective on earnings, because people may say, all right, it's a shortened week. You know, hey, we got Giants and Cowboys on Thursday. I'm getting ready for my sweet potatoes and all that. And like, don't forget, we do have earnings this week. We were going to hear from Best Buy, Nordstrom, Dick's Sporting Goods, and Dollar Tree. Some of these are really important names in terms of potential indicators for their broader sector. What should we be more closely paying attention to for this week's earnings, and not forget that there still are earnings, even if it is a shortened week?
No, you're right. There's enough important names, I think, to keep us all occupied. But I do think Best Buy is the one that I'm going to be most interested in, simply because it levers off of Apple in such a significant way. It's a consumer electronics retailer, as we all know, and a good portion of the sales, particularly around the holiday quarter period, are going to be the result of demand for Apple products, and particularly its new suite of iPhones. So what Best Buy has to say about not only its October quarter, but what it anticipates over the 3 months that will end in January is going to be hugely important, because it will speak to not only consumer demand, but what it is seeing from the supply chain disruptions that we've talked about with regards to the changes in COVID policy in China, the shutdown of some factories there, and Apple's own warning about delayed delivery of some of its higher-end iPhone 14s as a result. So, yeah, Best Buy is one that I'll absolutely be paying attention to. Deere, I think, is another one that sometimes gets lost in the shuffle, but it's just as important as Caterpillar in assessing demand for its industrial products and what it has to say about economic conditions going forward, particularly in the agricultural sector. So that's one I don't think that can be sort of dismissed either. And we'll get Zoom Communications at the end of the day. And that's, of course, a pandemic stock darling that has kind of struggled to hold investor attention since we've all gone back to some sort of hybrid work. But nonetheless, Zoom still remains a really important function for a lot of businesses. So we'll be interested to see what they have to say with their forward outlook as well.
Yeah, Zoom is down alone 55% year to date. You're right to this point about being a pandemic darling. It was an entirely different story back in 2020 when we said, wait, we have to do what now to talk? And obviously things have changed quite a bit. So that's very good there. Okay, with the remaining minutes we have left, because improbably it's already nearly 10 a.m. FTX, you want to talk FTX real quick? Because I legitimately sit there and say, God, I would love to know what's top of mind for Martin. So if you're willing to indulge, I just want to quickly present the latest bit, of headline here. This weekend, the company was forced to reveal, as part of its liquidity process, right? You now have to reveal information about your creditors. We don't know exactly who the creditors are, but Martin, we did learn an awful lot about how much they are owed. And the company owes the 50 biggest creditors $3.1 billion. As the bankruptcy, again, this whole process of having to now force the hand of the company to now be transparent. How big a piece of information was this that we learned this weekend?
Well, I think that was one of the first significant numerical pieces of information that we can actually hang our hat on. It's coming through the Chapter 11 process. So it has, if not the solidity of an audit, at least it has the probity of someone who is marshaled to put this data together. And that, of course, is John J. Ray, who is now the CEO of FTX, but is essentially an administrator of the company. He's a well-trusted individual with great respect in the bankruptcy and restructuring community. So what he has to say, I think, is going to be of far more significant importance than anything that has come out of the executives prior to that. But it paints a grim picture, JD, because it's $3.1 billion to the top 50 creditors. There's no chance that assets can be found to satisfy that. So that probably does paint a grim reality for the people who have deposited money onto the exchange, because it's very unlikely that they're going to get any kind of compensation whatsoever if the top 50 are going to be aligned with whatever assets can be scraped together. And really, just from what we understand of the mechanics of this business, it seems even worse than first anticipated. And that's really saying something. Ultimately, depositors had their cash directed, so it seems, to the Alameda hedge fund side of the business rather than the FTX side. So therefore, when it all came to collapse, because the Alameda side had essentially gambled away those deposits, there's nothing left for them. They were never segregated in the first place. And therefore, how they can be aligned in a credit clawback is unclear. And even if it were clear, the assets don't seem to exist to do it. So there's going to be a great deal of pain for those who participated in this company, and the sort of the post-mortem, not only of its collapse, but how it was allowed to execute its business in the first place, will carry on for a long, long time.
Yeah, this is a very messy story. We're also seeing it turn political, and I do want to get your perspective on what at least early reaction we've seen out of Capitol Hill. It's interesting because on the one hand, my years of covering Congress taught me the Senate is the cooling saucer of the two chambers. The House of Representatives is the wild, wild west. Like, they will say and do and throw anything at the wall, but usually in the Senate, cooler heads prevail. But what I've realized in this story is it's Republican senators that have been very quick to capitalize on the donation link between Sam Bankman-Fried and Democrats. So you got people like Josh Hawley, a Republican senator from the Show Me state of Missouri, and he's saying, well, we want to investigate, we want to get to the bottom of this. He's playing politics on this. Strangely, it's the House of Representatives, which is about to change hands, which in the lame duck session is about to hold a very rare bipartisan committee where they want to hear from Mr. Bankman-Fried. They want a representative from Alameda. They want a representative from Binance. I can't imagine they're going to get CZ or someone too high-ranking. But Maxine Waters and Patrick McHenry, the Democrat and Republican leaders, respectively, of that committee, seem to be pushing aside politics for now, Martin. And they're going to say, hey, we want someone here in the month of December. What is going to be top of mind for you as this conversation now starts to work its way into Capitol Hill, both in terms of substance and getting answers, as well as, for good or for bad, scoring political points?
Yeah, I mean, that's what it looks like to me, JD. I mean, I see just dozens of lawmakers gazing down the pasture whilst the horses are galloping on into the distance and then turning around and bolting the stable doors. I mean, the time for these questions was many, many months ago, and certainly not now when all the money has disappeared. So much of it just seems like such a show trial, regardless of who actually arrives to DC to take the questions, because however penetrating they might be, they're not going to get to the bottom of the issue. Regulation has been an issue with cryptocurrency for more than a decade, and it remains so. There's still no broad agreement as to how or even which agency should take the helm of the regulation. And as a result, you have bifurcation in rules for crypto versus crypto exchanges versus tokens and everything else. And therefore, companies were encouraged to go offshore, where regulations were even lighter, in order to make sure that they could engender the business models. So to me, it doesn't appear that we're going to get to the bottom of what happened, and we are more simply going to create political cover for those people who were simply either uninterested or unable to police this industry in the first place.
Yeah, I remember this is the same congressional hearing that a few years ago had the Robinhood and the GameStop individuals, and had Keith Gill, Roaring Kitty from the very popular subreddit. That was Chairwoman Maxine Waters. And for the most part, I would argue, in terms of contentious committees, she and Ranking Member McHenry have, pretty much been in lockstep on things. Like, for a chamber that is very good at throwing food back and forth, House Financial Services does have a way uniquely of responding to these things. And it's also amazing that they're going to try and jam this into the month of December, when we all know one Congress is ending, someone else is taking over. But I actually think it's an indication to the leading Republicans on that committee to say, yeah, we're not even going to wait for us to get the gavel. This is important. We need answers now. That's going to be a fascinating story you and I will talk about at least once or twice, I suspect,
I should
in the next few weeks, especially if this guy ends up going on Capitol Hill. I don't know if he will, but we'll see. All right, time now for our rapid fire section. I do want to get through a few of these with you in the next few moments if we can. Number one, Donald Trump and Twitter. For now, he is snubbing the platform. We know Elon Musk wants him back, but is Truth Social on the ropes? This is complicated, right? Because he's got the SPAC deals, trying to take it public. He's got these regulations about what he can and can't post on other platforms. It's not as simple as just allowing @real Donald Trump back on Twitter, right?
No, precisely, JD. It is quite complicated, and I'll try to boil it down as best I can. Truth Social, which is of course, the social media platform, is attempting to do a merger with a company called Digital World Acquisition. When they come together, they will list onto the NASDAQ, and then, of course, they'll be able to raise more capital and, as a result, drive growth for the platform. However, there are significant investigations into the details of the merger, most notably from the Securities and Exchange Commission, and therefore it's been delayed for a number of months now. In order for it to continue, shareholders have to approve an extension of that merger, which was expected to be completed in September of this year. They'll actually vote tomorrow. But getting the 65% threshold for that vote has been exceedingly difficult because there are lots of retail investors and they're scattered all over the country. So the chances of getting to that 65% threshold are actually quite slim. And with the investigations looming, people are worried about the fact that the whole thing may have to be unwound as a result. And even beyond that, JD, the former president is kind of bound by the terms of his agreement with Truth Social and Digital World not to participate in the same way as he has in the past on Twitter. There has to be a 6-hour delay on tweets that he puts on. He must first put on Truth Social before he can put them on Twitter. And that agreement lasts into June of next year. So he is doing the right thing in terms of not sort of accepting the reinstatement on Twitter just now. But that could change very quickly if this Digital World deal were to collapse as a result of the failed shareholder vote, the lack of ability to extend the merger agreement, or indeed an intensification of the investigations, which again include the SEC.
Yeah, it's a fascinating story. Okay, on to number 2 we go. As the crypto fallout continues, is Coinbase now another name that could be in a bit of trouble? What say you, Martin?
Shares are opening at an all-time low, actually. We're seeing in cryptocurrencies and indeed Bitcoin itself, which is a big driver of trading volumes and, as a result, revenues for this platform. Now, it's really important to remember that Coinbase operates here in the United States under very strict regulations. It has one-for-one backing for the assets. There's no commingling of the money that's deposited onto the exchange and any other business operations. They're doing it right, and I think as a result, they should be applauded for that. But they are getting caught in the downdraft, not only of a lack of sort of confidence in the broader crypto space, but of course the lack of trading volumes as a result of the decline in Bitcoin prices, which the last I looked were hovering right around that 16,000 mark. So as a result, we've seen a significant decline in these shares. They traded at around, I think, $450, if I'm not wrong, JD, just after the company went public in April of 2021, and now we're down in the $42 range. I mean, that's a tremendous amount of capital decline as a result of not only the drop in crypto prices, but the lack of confidence in the market itself. They're going to have to claw that back, and I would imagine that given the platform and the seriousness of the business, they probably will, but it probably won't be to the levels that we saw when it first came to market, and it may take a long time to engender that confidence in a market that's just feeling the ripples across the board, not only from FTX, but concerns about Gemini, concerns about Binance, and virtually all the other major players.
All right, and third and finally, let's talk a little World Cup. We did have Ecuador knock off Qatar. That was the first match. And today we got USA versus Wales. Who you got? Who do you like here? And I'd imagine it's actually Friday's match you're probably even more interested in.
Well, I thought today is a terrific slate with England playing Iran and looking very good in the first half at the very least. Senegal and the Netherlands is a terrific tie with just exceptional athletes on both sides. And the USA-Wales match, I think, is going to be a good one. I probably do fancy the Americans in today's match. I think they're a lot more technically sound than they have been in the past. And, of course, they have some terrific players with Pusilich leading the way. So I'd probably put my money on the Americans. It'll be difficult to say how far they can go in this tournament because I do think that it's a wild card with respect to there isn't the gap in abilities that we've seen in many of the past tournaments, and this one might actually bring us together with the top 8 or 9 teams really all having a decent shout. But yesterday's match was not a good start for the tournament, I don't think, particularly the hosts, which were the first host losing side in the history of the World Cup, and a bit of a farce on that VAR decision as well.
Yeah, absolutely.
Mhm.
God, we could do an entire hour-long special just on the controversies that have already
Totally.
rocked this tournament here.
Mm.
Black Friday, USA, England. It's going to be an amazing day, and I can't wait to talk about it with you as I spilled my coffee on the desk. That's how excited I am for the World Cup. I'm knocking things over here. That's going to do it for our broadcast, Martin. Enjoy the match later on today, my friend. We get to do this again tomorrow. So many more important things to talk about. The great Martin Baccardax. Thank you.
Thanks, mate.
All right, my man, that is going to do it for the market open here from The Street. Stick with TheStreet.com for more on these, all of these, and all of the major market stories that matter to you. I'm going to go clean up my coffee, and we will see you tomorrow. See ya.